Hello friends, welcome to our next tutorial, which is around operational risk data and its governance. So previously, this is the part 3. In part 1 we have read about how to categorize operational risk data, which is basically operational risk taxonomy. Then we have covered how companies gather this operational risk data. In that we have studied about internal loss data, which is companies' own inbuilt data based on their experiences of their events. Now we will cover other sources of this loss data. One of them is external loss and another one is scenario analysis. So in previous tutorial we have covered internal loss data. Now we will be covering external loss data and scenario analysis. Now we will slightly touch upon external loss data because we have a dedicated chapter just after this chapter on external loss data. So we'll just quickly touch about it and then we will quickly move to scenario analysis, which is quite big in itself. Okay, so let's start with external loss data. It's not a replacement for internal loss data. So as we have discussed previously, external loss data is basically data of various companies which is collated by a third-party vendor or by company themselves through magazines or etc. or reading the newspapers, articles. There are ways, we'll discuss about what all ways are there for collecting the external loss data, but just understand what exactly is the external loss data. It's the loss data of other companies. Now, for example, where does this external loss data helps? So first we'll try to see how does it helps companies, and then we will see what all ways companies can get hold of this external data. As we have discussed, it is no match to internal loss data because internal loss data in itself is very neat and clean. Company has built it itself. So that's why it's high quality, it's absolutely related to that company, and it's basically learning from past experience of that company itself. So there is no match to internal loss data, but then this how external loss data is important and how it complements internal loss data is now we are going to see a small example. So let's say there is a big insurance company which wants to expand its motor insurance in a new state in which it has not been doing their business so far. Now, if you remember from past tutorial that Basel requires company to have 5 years of loss data at least. Now, since this company is new, and it is going into, this company may be old, but it is going into new market, it has no data for that market. So what it can do is, it can use external loss data. So it can go to a third party vendor to provide informations like what is the density of that area, basically person per square feet, what is the motor density of that area, which is vehicles per square feet, because that is what increases the probability of accidents and people losing life in those accidents. So that kind of information is basically dependent upon one market to another. So this is that example which we are talking about. Now, so that's why this is very important that company gather whenever they are new into that market or into that country, into that state, they use the existing data of that state through external loss data. Okay. Now once we have slightly touched upon the importance, let's see how companies can get hold of this external loss data. One of them is internally developed external loss data, which means company is collecting all this information through various books, newspapers, journals, etc. And it is internally developing this data, storing this data rather, in the format, etc., with whichever best suits that company. Second thing is consortia. Consortia is basically group of companies coming together and forming a alliance or a group which helps all of these participants. For example, let's say out of all 20-25 banks in India, they decided to come up and create a CIBIL score, which helps them track people who have taken credit cards and have not paid their bills on time, or they have run away with the credit card money. So that is one example of consortia. Now, this could be provided by industry bodies. For example, this idea of CIBIL was not of one bank or two banks. It was a need for the day. So entire banking regulator come together and they did something for entire banking system. So for example, RBI for banking, IRDA for insurers, all these can give guidelines that we have to come up with such kind of facility or consortia which could provide data of all the participants to all the participants, right? Data of all the participants to all the participants. So consortia, that system, for example CIBIL, is responsible for collecting data from all the customers or all the banks and providing it to all the banks. Then it could be vendors, the private vendors. It's IBM, it's written IBS, unfortunately. It's IBM, SAS, Reuters, who provide this kind of data, and they take a subscription fees or premium or charge or license fees for providing this data. So that way they earn profit out of this business. Okay, so let's talk about scenario analysis. We'll quickly move on to scenario analysis. We'll hold external loss data discussion for now because we will be covering it in a new chapter. In fact, it's just next to this chapter, a dedicated chapter for external loss data, because it is very, very important and it's a market in itself. So we'll hold on till then and we'll focus on scenario analysis, which is again very, very important. Very, very important for banks. So what it says is scenario analysis is defined as a process of evaluating a project, portfolio or asset by changing economic conditions. No, it says that economic, market, industry, company specific factor, but let's call it all together as economic conditions or economic environment. What it means is that if this project, if let's say a company is building a bridge over a river, then a typical scenario analysis will look like, what if cost of cement goes up? What if cost of labor goes up? What if cost of labor goes down? What if cost of cement goes down? What if there is a flood in the river? What if there is lots of rain, monsoon gets extended, or there is a drought? So all these kind of things, and then they will evaluate profitability of that, of constructing that bridge in various economic conditions. If economic condition is, it could be drought, it could be flood, it could be shortage of labor, it could be shortage of cement, it could be shortage of other raw material, etc., etc., etc. So these all together forms different economic conditions, and then you judge profitability of that project under various economic conditions. Okay, for let's take an example for a financial firm. So a financial firm could be, I want to see how my loan portfolio, or let's say home loan portfolio, will behave if interest rate in market goes down by 1%. So then what would happen is lots and lots of customer will close their will prepay their loans and move to a bank who is offering a lesser rate. Other thing could be companies would have to take profit hit, or profit margin will get diluted because that bank in itself would be forced to reduce the rate of loan, rate of interest on that loan. Then another economic condition could be, what if there is a huge drop in collateral? For example, company is taking homes for giving home loans as a collateral. So until the home loan is completely paid off, that home basically remains in the name of bank. What if value of collateral goes down by 10% or 20% or 30% or 50%, something similar to 2008 that happened? So pricing of property goes down, and then companies do not have enough collateral, and then if there is a default, even if company sells the collateral, they can't recover. Then there could be, what if there is a natural calamity? So company is giving loans in a country, and then what if that country got hit by a natural calamity like drought, flood, war, etc., and then in that case people will not be able to pay back their loans. So all these things are basically different economic scenarios that needs a lot of scenario analysis. That's where scenario analysis is helpful. Why it is helpful is because, let's say, let's pick up an example of a big bank. Let's say Barclays finances a lot of European countries, let's say Italy, and then since Italian economy is almost on a brink of collapse, it might prevail, it might collapse, but nothing can be said as of now. So when giving a loan in that region, what happens is Barclays will have to do a lot of economic scenario analysis, where they will have to see what if economic conditions further degrade. Let's say what if GDP reduces by 1% next year, then what would be the losses to them on their loan portfolio? What if currency devaluates by 10%, what would be effect on their loan portfolio? What if interest rate, their central bank cuts down interest rates, what would be the impact on their loan portfolio? Now all these conditions have not happened in past, so that's why there is no exact loss data, whether internal or external. So that's why company needs to sit together with various experts who are experts on mortgage business, and then come up with the estimate of losses that could happen. So that's why what it says is scenario analysis are specially useful tool for estimating losses when experiences related to emerging risk are not available in financial institute, which is the second point here. In that case, generally experts are asked for their opinions. It could be through structured workshop. Workshop are basically when you take a lot of experts in group and then you give them various scenarios and ask them to do brainstorming together and all those things. So that is a structured workshop. Survey is simply sending them a questionnaire. Then individualized discussion is basically one-to-one sessions. So these are generally three most common techniques used by companies across the world to do scenario analysis. Generally, structured workshops are found to be most efficient in terms of new information that can be gathered, because generally a lot of experts, when they think together, they are given various scenarios to brainstorm, time to brainstorm, and an environment which is conducive to thinking and discussion, then a lot of new information comes up. So this is a small result of a survey which was done to find out which is the most effective method, and then structured workshop are found to be most favored method. So what it says is it's the number of banks that uses what techniques for doing scenario analysis. So most of the banks prefer structured workshop for doing scenario analysis. And then number of new scenarios that banks come up with every year is most of the banks come up with 50 to 100 scenarios every year. Okay, now we come to challenges in scenario analysis. So entire scenario analysis is based on discussions with experts. So that is the main thing about scenario analysis, that it depends on experts. If expert is not good, your scenario analysis results won't be good. If expert is having some problem, then scenario analysis is bound to fail. Now, so that's why the major problem which scenario analysis faces is about biases. Bias is basically preventing people from thinking independently. They are stuck to some point or some belief that is preventing them to think independently. We'll talk about some of the common biases, and then you will understand how biasing of expert can lead to faulty results out of scenario analysis exercise. So we'll talk about them. We'll spend some time on it because this is an important concept. It will also come up in investing and market risk and behavioral finance. If somebody is looking to make career out of behavioral finance, this is basically the starting point of behavioral finance. Since it's going to come up in 2-3 more units, so we'll take some time spend here so that we don't have to spend time going forward on it. So first of them is presentation bias. It occurs when the order of information is presented impacts the opinion or the advice. So it's similar to a very common cliche which is called as glass half full or glass half empty. So if somebody have to make positive outcome, then he will think of glass which is half filled with water as it is half full. If somebody has to spread negativity, they will think of it as half empty. So which is a common cliche. It is nothing but the very simple example of presentation bias. So let's say mutual fund scheme earned alpha of just 1%. So it kind of gives an impression that mutual fund scheme was not doing well. Then second way of presenting it is mutual fund scheme was still able to generate alpha of 1%. Then it makes you think, even if the second line is not there, despite through market condition, just read till 1%. So XYZ mutual fund scheme earned alpha of just 1% versus XYZ mutual scheme was still able to generate alpha of 1%. Correct? In first example, where we say XYZ mutual fund scheme just earned 1% alpha. Alpha is basically extra return that a mutual fund is able to generate over and above the market return. So let's say Nifty is giving 5% and then mutual fund scheme is giving 6%, then alpha is 1%. So what it says is, in first statement it looks like mutual fund scheme is doing very bad. Now if it is presented as mutual fund scheme was still able to generate alpha of 1%, then it looks like it is doing very good and it has some challenges, still it was able to generate alpha of 1%. Forget about the last line, despite tough market condition. If it is written as XYZ mutual fund scheme was still able to generate alpha of 1%, you automatically think that there was tough market condition and you look them in a positive way. So that's what the difference is between presentation biases could lead to. Second thing is context bias. So context bias occurs when questions are framed in a way that influences the response of those being questioned. Now here is an example which says that, so you would be aware that Punjab National Bank or PNB Bank in India had to suffer huge losses of around 140 billion rupees, which is 14,000 crore rupees, due to a person called Nirav Modi who ran away with all the loan. They took the loan from bank and then they ran away. So their company, they took the loan for their company and then they got hold of that entire money for themselves and then they ran away. Okay, now in this example what it says is poor controls in banks can lead to high value frauds. Recently there was a fraud in PNB Bank where client ran away with 140 billion rupees. What could have caused it? So the way this question has been put up, or the context in which this question has been put, this question if was asked to an expert independently, that Bank of Punjab National Bank basically faced this fraud, what could be the cause of that fraud? Then expert would have thought about government regulation, that government was not able to catch that person on airport, or there was these shell companies, etc., and all those things. There was money laundering, there could be anything. But then since it was presented in a context was already given that poor controls in the banks generally lead to high value frauds, and then this question was asked, so then immediately experts start thinking about that bank has some deficiency in their controls, that's why this kind of fraud has happened. So that what context bias is. So the way you are asking the question in between the entire and the context that you are giving around that question basically influences the opinion of the expert. Okay. So let's move to the next one, which is, yes, availability bias is related to experts' experience in dealing with a specific event or loss risk. For example, asking a front office trader about the settlement risk. And they will have their limited knowledge. They might be expert trader, they might be expert in front office processes, but then that settlement process they might not have ever seen it. They might have never felt the pain points of that settlement process, etc. So there is a availability bias here in the outcome or the opinion of that expert, because that expert is not qualified enough. They are qualified, they are very qualified, but they are qualified in some other areas. The anchoring bias can occur if an expert limits the range of loss estimate based on personal experiences or knowledge of prior loss events. So let's take an example. If an expert in his or her life had seen many thefts in bank but have not seen theft of more than 100 million. So maximum loss that expert might say for that theft risk is 100 million, irrespective of bank's cash management process, size of bank, region of operation, etc. Quite clear in itself. If somebody has not seen a loss of more than 100 millions over a various types of theft, then they would tend to believe that 100 million could be the maximum loss that could happen in a theft. They might not be willing to agree that that loss could be, let's say, can go to even 500 million. And in that biasing, they forget that this bank has a very different cash management process. There may not be verification of people transporting the cash, etc. This bank might be at higher risk. It might be a very huge bank. It might be operating in regions like Pakistan or Africa where there's such kind of things are more prevalent. Okay. So next is confidence bias. Expert may over or underestimate amount of risk for a particular loss if there is limited information or knowledge available for risk or the probability of occurrence. Now, an example here is, if asked a question of bank losing money due to terrorist activity. Then an expert in India, if it is put to Indian expert, this question is put to an Indian expert, they will generally overestimate that value, because the knowledge that they have of these kind of events due to terrorists from Pakistan and neighboring countries coming in and then causing losses to Indian financial firms and Indian industry. So they have that knowledge, they have seen that. So they tend to overestimate it because they know the seriousness of it, what could it lead to. But if this question is asked to person in Iceland or Switzerland, where terrorism is not even in picture, they might underestimate it. They might think that such kind of events rarely happen, they do not happen much. But since particularly in India, people would have heard about Yes Bank, whose MD unfortunately got killed due to terrorist activities. So that kind of memories basically, or that kind of knowledge will generally lead to overestimating the amount of money that bank can lose due to such event. Now since this example can be put in the anchoring bias also, or availability bias also. Since this is human nature, it is like human do not think in compartments. There's a lot of things that put in together, they influence the decision. So that's why these are very closely related. There's very fine line among it. Okay. Then there are few more biases. Hurdle bias, which is basically expert might be an expert, she might be a genius in their own field, but then that does not mean that they would be an expert public speaker. They would be able to efficiently present their views in a workshop, in a group. So that is quite possible, and that is what is hurdle bias is. So there are a lot of people who don't want conflicts within the group. So that's why even if they have different opinion, they might not be able to voice it. They might just keep it to themselves, thinking that this might lead to conflict, and they might have to do a lot of explanation, etc. So they just tend to keep quiet and keep that information to themselves, even if they are correct. Then gaming bias. Some expert may have motive of not participating or providing full information in workshop. For example, bank is trying to hold how much capital is needed for settlement risk, and then there could be an expert who is like kind of business unit head for settlements. They might tend to underplay it, so that bank has to keep less capital for that business unit, and then that could result in more profits, because that capital cost is going to be charged to that business unit in any way. So there is a bit of motive. If more is the capital, then that capital cost gets charged to that business unit, and then their profit gets reduced. Although their unit becomes more safe, but then their profit gets reduced. So business unit head might think that, okay, these events happen once in a while, so why not just underplay it, take the profit, take my bonus, and when it happens, we'll see. So this could be one of the things which could lead to wrong output out of scenario analysis. Inexpert opinions, again it comes out from hurdle bias. So expert might be an expert in their field, but then they may not be a good speaker in group, so they may have that fear of speaking up publicly and things like that. Or that expert might be too busy, since they are like genius in their fields, so they won't be sitting idle. They would be having a lot of work on their hand. They might not see the scenario analysis exercise as that much important to doing their daily business and daily work. So what they do is they generally send their juniors or colleagues who are working with them, so who may not be they may not be that high level of expert in that field, so which leads to inexpert opinion. Okay, so these were some of the biases. Now, one of the techniques which generally helps in performing structured workshop or in doing scenario analysis is Delphi technique. It was, I think, developed by somebody in US Armed Forces. So what it does is, so first we'll see in what condition this Delphi method could be used. So one thing is where precise mathematical models are not available and subjective opinions from lots of experts needs to be gathered. So there's no way to model, let's say, a theft risk or a fraud risk, but then it depends upon experience of various experts. So in that case, Delphi technique can help. Second thing is where experts from various background of experience needs to be presented a case, let's say overall loss to bank due to something, let's say a regulation which will have a market impact, which will have credit impact, which will have operational risk impact. So in that case, lot of experts from diverse background are required to brainstorm. Again, group meetings are very costly. There would be, like, let's say, international regulation on ban of plastic, then let's say a manufacturing firm operating across the world, they might want to see how, they might want experts from USA, India, China, UK, Russia and all those regions to be present at one particular place to conduct this workshop. So it would be very, very costly. A large number of opinions are required and face-to-face meeting is not feasible. The other way is face-to-face meeting is not at all possible. Okay. Now let's see how Delphi helps in these conditions, or what is the basically format of doing the applying the Delphi technique in structured workshop. So discussion and feedback is basically, so all the experts are not put together in one room and asked to brainstorm. So there is a precursor to it. So what all the experts are first asked, all these experts are first asked about the situation. All the feedback is gathered from all those large number of participants. Then that feedback is summarized, and then an expert public speaker who is expert in organizing this workshop, who is expert in public speaking, group activities, then that person presents this information to the entire group. And then, of course, since individual feedback or discussion points were gathered from all the experts individually, so there would be lot of differences in the outcome. Again, for example, let's say terror financing. There is a workshop on terror financing, or what could be lost due to terrorist activities or banks involving in terror financing. So again, there could be a bank in India who will treat this as very high loss. They will treat it as very, very important. But then there would be a bank in there would be a, let's say for a bank there is a India operations and there is an Iceland operation. So head of India operations will treat it very seriously because there's a lot of terrorism in their neighborhood because of few neighboring countries. But then peaceful countries like Iceland, they may not be putting that much importance. So then there would be a difference of opinion, and then this expert communicator will try to bring them on same ground. For example, they will ask guy or the head of Iceland unit why they have given, let's say, a loss could be only 10 million due to a terrorist activity. They might give up reasons that our country is safe, we have never seen an terrorist event, we have never seen any casualty due to terrorist event, so we have put a less number. And then India head would be asked about the same thing. They would say we have given 100 million because of so and so and so reasons. And then after both the expert have shared their knowledges, they generally tend to agree on a common number. So that's what is done as part of third step where difference in feedback is evaluated. And then finally the reports is all the recommendation etc. are incorporated, all the feedback is incorporated, and then it is presented back to all the participants and then finally to the senior management. So that's what Delphi technique does. Instead of just putting all the people in one room and asked to do brainstorming, what it does is it takes step 1, it asks all the experts about their opinion individually. 2, it assigns an expert communicator to present that summary. 3, any difference is basically handled during that session. And then 4th, once all the difference of opinions are taken care, then a common report is presented and then sent to senior management. So with that we complete our discussion on external loss data and scenario analysis. We'll look up, there's one more part to this presentation which we will be shortly uploading. Till then, thank you and all the best for your studies.